Types of risk explained simply. When people hear the word risk, they think of loss. But risk is not just one thing. In business and finance, risk comes in many different forms. A borrower may fail to repay. Markets may suddenly crash. Systems may fail. Reputation may collapse. Strategy may go wrong. Each of these is a different type of risk. If you understand the types of risk clearly, you understand how organizations protect themselves. In this video, I will break down the major types of risk in simple language so you can see the complete picture. Let us begin. The first major category is financial risk. Financial risk directly affects money and valuation. Within this category, there are three major types. Credit risk, the risk that a borrower fails to repay. Market risk, the risk of loss due to changes in interest rates, stock prices, exchange rates, or commodity prices. Liquidity risk, the risk of not having enough cash to meet short-term obligations. These risks directly impact balance sheets and profitability. Banks, financial institutions, and corporates constantly monitor financial risks because they can escalate quickly. Financial risk is often measurable using data, ratios, and stress testing, but managing it requires discipline and foresight. The second major category is operational risk. Operational risk arises from failures in internal processes, people, systems, or external disruptions. Examples include employee mistakes, internal fraud, system breakdowns, cyber attacks, process weaknesses. Unlike financial risk, operational risk is about execution. A good strategy can still fail if operations are weak. Operational risk often builds silently. Small control weaknesses accumulate over time. When they are not addressed, they result in larger failures. Strong internal controls, audits, segregation of duties, and system safeguards help reduce operational exposure. Operational excellence is the foundation of sustainable performance. The third major category is strategic risk. Strategic risk arises from poor business decisions or failure to adapt to change. For example, entering a market without proper research, ignoring technological disruption, overestimating demand, expanding too aggressively. Strategic risk affects long-term direction. It may not cause immediate crisis, but over time, it weakens competitiveness. Closely related is business risk, the risk that overall business performance may decline due to changing industry conditions. In fast-moving industries, strategic agility is essential. Without it, even profitable companies can lose relevance. Another important category includes compliance and reputational risk. Compliance risk arises when organizations fail to follow laws, regulations, or internal policies. This can result in fines, penalties, and legal action. Reputational risk is the damage to trust and public perception. Often, reputational risk follows compliance or operational failure. For example, a data breach may lead to customer distrust. A governance scandal may reduce investor confidence. Reputation is intangible, but extremely valuable. Trust takes years to build, but minutes to damage. In industries like banking and finance, credibility is everything. Finally, there are systemic and emerging risks. Systemic risk affects the entire financial system or economy. It spreads through interconnected institutions. Emerging risks include new threats such as technological disruption, cyber evolution, climate exposure, and geopolitical uncertainty. These risks are dynamic. They evolve constantly. Let us summarize the major types. Financial risks, credit, market, liquidity. Operational risk, internal failures. Strategic risk, wrong direction. Compliance risk, regulatory exposure. Reputational risk, trust damage. Systemic risk, interconnected impact. Understanding these categories gives you a structured framework. Risk is not random chaos. It is identifiable, measurable, and manageable. And organizations that understand risk types clearly are better prepared for uncertainty. Because in business, awareness is the first step toward resilience.